Good morning and welcome to the Real Investment Show with Lance Roberts. I'm Brent Clanton, executive producer for the show, and if you're seeing this video, that means Houston has been iced in by a polar blast. And we decided it would be better to stay home and instead roll this interview that Lance recorded earlier a few days ago. So without any further ado, here's the Real Investment Show with Lance Roberts. Thanks for watching.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's the Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Welcome to today's edition of the Real Investment Show. It's another in our interview series here on the Real Investment Show where we try to bring you experts in different areas of the markets that can help educate you a bit better, help keep you ahead of what's going on, help you understand, even if an investment you're invested in, what the potential risks are. So today's very special guest is Parker White, CFA. He is from DeFi Development. We've had him on here on the show before talking about cryptocurrency, and just because of late we've seen so much volatility in cryptocurrency, a lot of the previous narratives seem to have shifted a bit. I thought it'd be a good opportunity to have Parker here to talk a little bit about what's going on in the crypto markets, what the future outlook for crypto markets continues to be. And again, kind of where we go to from here. But just from a brief background standpoint, Parker White, CFA, is the digital asset and decentralized finance analyst at DeFi Development Corporation, where he focuses really on blockchain-based financial systems, crypto asset market structure. And again, we've had them on the show before talking about how they use Solana as the backbone of their digital asset treasury company, which is DeFi Development. And welcome to the show today, Parker. How are you, sir?
Thanks for having me, Lance.
Absolutely. So again, I think just kind of starting out from a high level, there's a lot of again, for a lot of investors, they hear about cryptocurrency and they read about it, and there's a lot of talk. And again, we have two very kind of divided sides, it seems like, in cryptocurrency. I guess less so today. It seemed to be more divided in the past, but I think people are kind of starting to migrate a little bit more to the middle. But again, there's still just a lot of uncertainty about, is it really an asset, or is this just a flash in the pan that will ultimately go away? Conversations around, the blockchain. What is that? What does it mean for the future? And I thought maybe we could just kind of start with some of these kind of basic understandings and kind of build a framework for somebody that either is invested in crypto about what their outlook may be. Is it right or is it wrong? Or if I'm not investing in crypto, but think I should include it into my portfolio as part of a diversified strategy, is this the right time to buy it, or is there more risk? So, kind of with that idea, I think we can just start with talking a little bit about what's been going on lately with Bitcoin. Bitcoin has traditionally had a very high correlation kind of with the NASDAQ in general, kind of risk on assets. There's been a very good correlation with that. That correlation broke a few months ago. There's a good correlation between Bitcoin and, of course, itself. Just talking about Bitcoin as a measure right now, as a proxy for cryptocurrencies. But Bitcoin has a pretty good correlation with Fed monetary policy. That seems to have broken down lately. So, kind of what's been going on, Parker? What do you think?
Yeah, it's a great question. And, honestly, this is the question that is befuddled the crypto community right now. So I'll give you my take on it. So historically, Bitcoin, and by extension, crypto, has followed the 4-year cycle. Mm-hmm. And so you look at, the prior bull markets and bear markets, the last, or the earliest one when I got in was back in 2017. I know there was one before that, or two before that, but 2017, Bitcoin peaked at about 20K. And then throughout 2018, it came down. And then 2021, and this was fall, late fall, early winter of 2021 in November, Bitcoin peaked at 69 and then started coming down. And 2022 was the start of the bear market. And so kind of right on schedule, here we are, 2025 in October 10th was the peak, and Bitcoin peaked at 125, I think it was, and then it started to come down. And so what you kind of have right now, in my view, is this kind of two cohorts battling against each other. Obviously, it's the bulls and the bears, right? But you've kind of got this older cohort of Bitcoiners who've had Bitcoin for a long time. They think the 4-year cycle is kind of this like, religion almost, like, hey, every 4 years you're going to have a bear market, and it starts in October through December of 2018 or 2020, or sorry, 2017 or 2021 or 2025. It's like right on schedule. And so you saw this where a lot of old coins, meaning coins that hadn't moved for a long time, all started moving in October and November. So people are like, oh, the whales are selling. They think the bear market's starting. And there was some prognostications, hey, bear market starting. And so I think what that kind of did was broke the correlation that you highlighted, right? It broke monetary, global liquidity, monetary policy correlation. It broke the NASDAQ correlation. It broke, all sorts of correlations. And so that kind of spooked people. And you saw a lot of the selling mostly happen in October and November. Things kind of leveled off in December. But I think it's a real question mark now as to, are we going to actually have a bear market now in 2026, just like we had in 2022 and 2018 and 2014 before that? Or are we in a new era, a new paradigm where actually the whales that just decide to dump don't control things? It's actually the institutions, it's BlackRock, it's the long-term accumulators that are going to buy and kind of, make this a very shallow bear market.
So that's a really interesting point, and that was something I wanted to get to. I'm going to move that question up the ladder here because you brought it up. But it is a little bit of a different dynamic. So again, if we're talking about the stock market, right, we can talk about 7-year cycles in the market, 21-year cycles in the market, and those cycles are very apparent, and those typically revolve around economic growth cycles or recessionary cycles, those type of things. So there's a good and again, that reflects back ultimately on what drives stock prices ultimately is earnings, and so those cycles kind of tend to relate to each other. I remember that every time we went through one of these kind of concerns about bear markets, the general tenor was, oh, well, we're having a Bitcoin halving event, right? And that's causing this kind of decline in markets. But at that time, you didn't have a lot of institutional investors in the mix, right? You didn't have these big accumulators of Bitcoin, these ETFs, et cetera. You didn't have Michael Saylor at the time accumulating, kind of big positions in Bitcoin. And so my question to you is this, is that are we seeing a market that's being driven by fractionally smaller share? Look, we all know, just real quick, that price is driven by those that are buying and those that are selling. And so when you talk about, we've got holders that are selling, are they become a fractionally smaller proportion of the market because you have so many institutional investors, whether it's Michael Saylor or whether it's BlackRock or Fidelity or ARK Investments that also have an ETF? You have these much larger shareholders now accumulating Bitcoin for their assets and their business models versus the fractional few that may be buying or selling on the fringe. And does that potentially increase volatility in the future?
Yeah, I certainly think it doesn't increase. I certainly think it decreases volatility as you kind of broaden out the holder base. And the holder base isn't, just individuals that decide on a whim, they had a bad dream last night, so they're going to dump their Bitcoin, right? It's got investment committees that have allocation targets, and they do rebalancing, and it takes them months to get these things through committee. And I'm talking about sovereign wealth funds and large pensions. I mean, everyone's allocating to Bitcoin or a derivative of Bitcoin, whether that's an ETF or MicroStrategy, the big endowments, all these guys.
Right.
So I think what you're...
your company's doing it too. Yeah, your company doesn't. Just to be fair, you're doing the same thing. You're accumulating Solana. You're not doing Bitcoin, but you're accumulating Solana. So effectively the same idea. Yes.
Exactly. Well, and I'm wearing my my Bitcoin hoodie here, so I also accumulate Bitcoin. But so I think it's a really good, healthy thing, and you can kind of compare this to a lot of a tech startup that first IPOs, right? Where in the early days, it's very tightly held, right? It's the early venture investors, it's the employees. There's not a lot of holders, and so the price movement is a little more idiosyncratic. It's based on this small group, small niche of investors. But over time, as that supply gets out into the market, the story becomes really well understood. You have people all over the country and all over the world that are accumulating the stock. I'm talking about a tech company. Typically you see that volatility kind of come down. You see more long-term holders, and it's just healthy for the growth of the company. So I think in the same way, obviously Bitcoin's not a company, but some of those same dynamics are at play, where you've now got decisions being made across a much larger collection of investors that affect the price. And sometimes the decisions are going the opposite way, right? Some people want to buy while some people want to sell. But the more holders you have, the more you can kind of dampen out that volatility. And we've seen that. Bitcoin volatility has just been continuously declining. And so it could very well be that like this is the bear market and it's like, yep, it goes down 30 or 40% now, but like that's it, right? It's not the 60% drawdowns like we've seen in the past.
But that also, to your point though, that also, and again, I really like the comparison to the IPO. A young company, they come to market, and they're kind of new to investors, and you see they go on these rocket ship rides, right? You see these IPOs, they'll go up 100, 200, 300%. But as the company matures, that volatility in the price begins to drop. The price starts to stabilize a bit. It starts to track along better with, revenue growth and earnings growth and those type of things, which is what you should want as an investor. And for investors in crypto, in general, as you have more adoption, to your point, we're seeing volatility come down, which means that ultimately we should see, price movement start to stabilize around its underlying fundamental drivers. So maybe that correlation picks back up to the stock market. Maybe it picks back up to, monetary policy. That correlation becomes much tighter. The volatility, the declines in volatility drop. They become more normalized, but that also means the gains become more normalized. And so do you think we get to the point of where volatility where crypto becomes an investable asset that can actually be used as a diversifier of volatility in a portfolio rather than an increaser of volatility?
Yeah, and I think, the breakdown in correlations, it's been a negative breakdown, right? But sometimes it goes the other way. Sometimes it's a positive breakdown. But the breakdown in correlations with Bitcoin in particular has been an incredibly positive vote for portfolio diversification, right? Because that's the gold standard, right? You want uncorrelated assets that perform well on their own, but then independently of each other. And so I think Bitcoin's volatility coming down some will certainly help it be a better portfolio diversifier. But I think to the extent that it can maintain some level of non-correlation to more traditional assets will really help it to have a strong place, a small slice, but a strong place in, global allocation type portfolios, target date funds, all these things.
Right.
Well, you're starting to see more.
Yeah. And I get, I maybe I didn't phrase my question, kind of, properly, but, my point is that a lot of people will shy away from Bitcoin simply because it goes through these 40, 50, 60% drawdowns. Yeah, it has great runs up and then it gives it all back, right? And that kind of volatility, a lot of investors have a hard time stomaching that. But if you could get the asset to come down to a more normal level of volatility, say volatility relative to the S&P is maybe 1.5 to 1 versus 10 to 1, right? Something like that. Then that becomes a much more adoptable asset for things like target date funds, for things like, 60-40 allocations. I want to add a little bit of cryptocurrency to that. And that becomes a much more viable role within portfolio allocations and leads you to a much broader adoption because of that, right?
Sure. Yeah, I think that's the case. There are some assets that can exhibit explosive growth and volatility. And I'm obviously talking about gold and silver right now, right? Which, that's the world's oldest asset, basically, gold is, and had some pretty incredible volatility to the upside recently, which is great. And so I think investors, they like volatility, but they want the upside volatility. They don't want the downside.
I was just about to say that. Everybody loves upside volatility. Nobody likes downside volatility.
Yeah, exactly. So I think to the extent that Bitcoin can have shallower troughs and also troughs that make a little more sense, instead of just these things that it's like, what is going on? And turns out it was some random dark corner of the world that like had a problem. And so that impacted Bitcoin. To the extent that we can kind of get that out of the system, and it becomes very clear, like, oh yeah, liquidity is pulling back, global liquidity. And so Bitcoin's coming down. That makes sense. Like, as we can make the price moves effectively make more sense to more people, I think that makes it more of an investable asset. Because, even if vol is high, as long as you size it appropriately and it's non-correlated, it can serve a great spot in a globally diversified portfolio.
Right. Well, look, I mean, just as a good example, this interview is airing on Monday, and just on Thursday of last week, we actually reduced so we have a portfolio we call our all-weather portfolio, and it's based on the permanent portfolio theory. You're probably familiar with it as the CFA. And, in that portfolio, we hold about 15 to 18% in precious metals. And we were looking at the volatility change in those precious metals positions and looking at deviations from long-term trends and deviations from historical norms, those type of things. And so, it makes a lot of sense here to take some profits out of those, reduce those back to target weights in their portfolios. But if I'm going to do that, where am I going to put some assets? Where am I going to take those profits, right? Where am I going to reallocate those to that might have an opportunity to start to grow? And we just allocated that to Bitcoin because of this recent decline. Bitcoin's getting extremely oversold. Strictly technical, has nothing to do with, narrative cases or anything like that. Just looking at price performance, you're looking at cryptocurrency now. It's deeply oversold. It's got very negative momentum, very negative sentiment right now. As a contrarian investor, that's the type of thing I'm looking for to allocate capital to, because money will eventually start going, you know what? Gold's had a huge run. I'm going to take some profits there, and then everybody's going to be starting to look for the next asset. And this is just part of normal sector market rotations that occur. And again, this is our process. Again, this isn't for everybody, but this is just how we manage risk internally as well.
Yeah, it makes a lot of sense. I think you're going to see 2026, my belief, 2026 is going to be the year of the catch-up trade where, gold and silver start to cool off. Maybe the AI trade cools off a little bit and people are looking around saying, where do I put my money? And crypto's, been down. Similarly to how small caps have been beaten up for a long time, underperforming, and they've really caught a bid recently. I think it's just a rotation into small caps because large caps have been running. And so I think it makes a lot of sense to do a bit of a rotation. It
does. And, the narrative, of course, is right now is why are small caps running? It's this idea of this reflation trade where we're going to have this. This was the actual topic of our conference that DK just came and our economic summit that Daniel Kang just came and presented at. By the way, if you were at the conference, he did a great job. Talked a lot about your company, about how y'all run the digital asset treasury back and kind of what the future of Solana is. I learned some fascinating stuff about transaction speeds that I did not know at all, about how slow Bitcoin is in terms of transactional speeds relative to something like Visa. And then that Solana even has a much faster processing speed for transactions than even Visa. I was just completely fascinated. Anyway, I don't want to digress on a whole topic, but maybe we'll do that someday. But, it's part of this process of investing and those type of things is trying to understand these dynamics. And, this whole idea of we're going to have a reflation trade this year is this idea we're going to have this massive surge in economic growth with no inflation. That sounds great, but there's a lot of headwinds to that. Employment is not just booming right now. We're seeing GDP growth. Just recently got the latest GDP report at 4.3%. Sounds great, except it was all import and export related. There was the actual growth of the economy itself outside of the net export book wasn't that great. It wasn't compelling, right? It was about 1% growth versus 4.3. So, that puts a lot of concern this year that we may get some disappointment in some of these risk on trades that we're seeing. And that's making me much more aligned with trying to find assets that are maybe out of favor right now as an opportunity to divest some capital.
Makes a lot of sense.
I like a guy that just agrees with me. So look, so we kind of covered a little bit about what's been going on. Before we kind of leave that kind of function, and this relates to all cryptocurrencies now, particularly altcoins, which have performed even much more poorly than, say, Bitcoin or Ethereum or Solana even. A lot of these altcoins are down markedly more. What should, if you're a kind of an investor looking to build a portfolio, would you avoid altcoins entirely and just stay focused on kind of the major players, or do altcoins actually have a position within the portfolio longer term?
Yeah, I think likening it back to, equity investing, if you're kind of a passive investor, right, investing's not your full-time job, I would say just buy some Bitcoin. I personally run what I like to call barbell strategy. So Bitcoin and Solana, that's kind of my, my portfolio.
Mm-hmm.
But, you could buy the majors, right? Bitcoin, ETH, Sol, just kind of hold that, buy it in an ETF or buy it in a DAT. I personally like the DAT exposure, a little more leverage, more volatile, but a little more upside longer term. But there's certainly some gems to be found in the altcoin stack. I mean, there's thousands of coins.
Mm-hmm.
The problem is, likening it back to the equity investing, it's akin to, buying the S&P 500 or going and picking penny stocks, right? There's some winners amongst the penny stocks, but it's also a lot of losers, and the majority are the losers. And so to pick those out, you really need to go deep.
Right.
Now, you don't have to be a professional investor to understand these things. In fact, most of the people that are trading these altcoins are not professional investors. They do the homework, they go really deep. So if you want to be a professional altcoin trader, it can be done, but it's not for most people. And I would say for most people, just buy the top three, Bitcoin, ETH, and Sol, and just leave it. And you bet on the kind of longer term generational trend of financial disruption that these assets, digital assets, are going to bring to global finance, and not try to time, hey, is this coin going to pop, or this new ICO, is it going to do really well, or, whatever, because, it's kind of a needle in a haystack to find the gems.
Do you think that the industry, so for instance, in the securities industry, the stock market, right, there's a lot of regulation around a company going public, the financial reporting, all those type of things. Do you think that the cryptocurrency market itself, the entire market, would do better with a little bit more regulation in terms of, we see a lot of stories about people that just issue out coins and they were kind of fraudulent issues. And that kind of leaves a mark, right, on cryptocurrency as a whole. It's like, oh yeah, I heard about this, coin that was issued and it was just basically a scam and everybody lost their money in it, because that impairs the reputation. So do you think the market would do better with a bit more regulation on the issue? So if Brent and I want to go issue the Brent coin, we should have some. Brent shaking his head like, no, we won't do that. But should there be some type of requirement that we have documentation showing, yeah, we're issuing this coin, this is what it's used for, this is how it operates, this is where the money's being held. There's some security regulations around the holder of investor, funds, et cetera. So there's some responsibility on how those funds are used. Or do you think that hurts the industry?
I think a level, in whether that comes from regulation or more like self-regulation, SRO type things. I think a level of transparency, increased transparency, would certainly be helpful. I think anytime you add in requirements like, hey, you have to jump through these 2 hoops before you can launch something, it becomes 5 hoops and then 10 hoops. And then before you know it, you're paying $10 million a year in legal fees.
That's government though.
Right, exactly. So what I am in favor of, and you've kind of seen this happen already, so prior to DFDV, I was at Kraken for 8 years, one of the reputable US-based exchanges. And these exchanges, Coinbase is the same, they have listing procedures. So if you want to get your asset listed on Kraken or Coinbase, you have to go through a listing procedure. And we've done it ourselves, and it's, it's fairly onerous. You got to answer all these questions. It's not the same as filing an S1 for taking a company public, but it's a form of getting some information out there. And so as an investor, one thing that you can kind of do is say, well, if the coin's listed on Kraken or Coinbase, it's at least past some kind of minimum threshold, right? And so I think what could be helpful from a governmental standpoint would be some type of, bulletin board or place like Edgar, for equity filings, where coins can voluntarily decide, hey, you know what? We're going to go ahead and file all this information. There's maybe a template that, say the CFTC or the SEC puts out. We're going to go ahead and voluntarily complete this template. And then we get some type of, kind of stamp of approval, or at least stamp of saying like, hey, look, this project has filled out this thing. So investors can still go buy the dark coins, right? The coins that haven't completed the disclosures, but it's kind of a, buyer beware, there be dragons, so to speak.
Right.
And so I think the U.S. government can create, global regulatory bodies can create a framework for more disclosure and transparency without forcing assets to do it and projects to do it, and completely preventing people from, playing outside of the highly disclosed projects. So that's kind of the way I would like to see it done.
Well, no, and I think that's good. And I'm glad you brought up the exchanges like Kraken and Coinbase, because one of the questions that I get most often is kind of this question about how to buy, this is great, Lance, I want to buy some crypto in my portfolio. How do I go do it? And there's a lot of, talk about, cold storage wallets and, setting up your own wallet to buy your Bitcoin and how to store it. Of course, if you forget your passwords, you're kind of in trouble. Or should you buy it through an exchange, like Coinbase or like Kraken? Are there drawbacks to buying on an exchange where it's transparent, it's easy, I can see it every day, it's tracked? If I need to transfer it into, my Fidelity account, I can do that. Is there drawbacks to using an exchange like that versus, the more traditionalist, I should say, the demand that you should have it in a cold wallet type storage?
Yeah, I think for most investors, just leaving your coins on the exchange is going to be the best way to go. And I think that's partly because, the level of exchange reputability is certainly going up. And with the hopeful soon passing of the Clarity Act as a follow-up to the Genius Act, in the US here, these exchanges will have a little more regulation around them. So I think for most investors, just storing it on exchange or in some kind of custodian, BitGo is IPOing today. Today being Thursday, BitGo is a great custodian, but like these custodians, you can also store your coins on. It's probably the better place for most folks. You can certainly do the self-custody. You can get your hardware device and, write down your seed phrase or pound it into a piece of titanium, whatever. That's great. But that's, people that do that are also the types of people who do the deep research on the altcoins, right? And so for most investors, it's going to be safest just to hold an ETF, hold your coins on an exchange. And, and that's for US investors. I would say if you're in Nigeria and you want to hold Bitcoin, you should probably learn how to take custody of the Bitcoin, because I don't trust any Nigerian crypto exchanges, right? And so the advice is kind of different, but in the US, where you've got strong property rights for now and good rule of law, like your stuff's probably not going to be seized. In other places, that's not always the case. But that's the beauty of crypto, is that with a little $50 hardware device and, an afternoon watching some YouTube videos, you can take possession of your wealth. And it's far easier and far safer than withdrawing pallets of cash from a bank account or bars of gold or something, right? So that optionality is really fantastic, but, not everybody should exercise it, because like you said earlier, if you lose your seed phrase, it's gone, and there's no one there to bail you out.
Yeah, I still remember the story about the guy who bought Bitcoin like 15 years ago, and he had it on his laptop, and he wound up throwing, Bitcoin didn't do anything for, the first 5 years or so, and wound up throwing his laptop away. And then, of course, Bitcoin goes soaring to the moon. He spent like $80 million trying to find this laptop in this landfill, never found it. But, that's kind of the problem, is if you lose it, you're going to be in trouble. So, these things happen.
Yep.
But that's good. That's good advice. And I think that's important. And now a lot of major custodians like Fidelity will allow you to hold cryptocurrency in your major custodian as well, where you also get additional coverage through their insurance policies and those type of things. So I think for investors, there's a lot more. And I think this is great for the crypto community. that optionality now provides a lot more stability for investors to bring capital to market.
Absolutely.
So when Bitcoin first came out, right, there was all the talk about how, the blockchain was going to change the world. We're going to be doing, in 10 years, we're going to be doing everything on blockchain. The banks are going to be out of business for all intents and purposes. That really hasn't come to fruition in 10 years. The viability of the blockchain is certainly there. The ability to execute and validate transactions, certainly very much there. We've seen an explosion of the underlying coins, right? We've seen all kinds of coins getting issued for different purposes, whether it's Ripple, Ethereum, Dogecoin, whatever. But the actual use of the blockchain, where we're executing real estate transactions or executing stock transactions through the blockchain, that has not yet come to fruition. Now we're hearing a lot of talk. Right now, it seems to be picking up a bit of traction that those things may be in the works coming. I think part of the reason that it's taken longer to mature is because of the volatility of the price of Bitcoin. As an example, if we're going to do a transaction in Bitcoin and it moves 20 or 25% in a day or two, that makes it very difficult. That type of volatility makes it hard to deliver manufactured products or to close a real estate transaction. But if we can bring volatility down, like we talked about before, through adoption, it certainly makes the viability of using the blockchain, which is really probably the most important factor of cryptocurrencies, is that underlying blockchain, makes that a much more realistic possibility. And we've even talked recently, I think JP Morgan even stated that they were kind of looking at blockchain for the execution of market transactions. Just kind of want to get your thoughts on that.
Yeah, so I think you're seeing pockets of usage that are, definitely a sign of product market fit. The big one that I'd highlight is stablecoins. Mm-hmm. So stablecoins today collectively about 500 billion in assets, and Tether, the largest stablecoin, is I can't remember the exact number off the top of my head, but I think it's like the 7th largest holder of U.S. Treasuries in the world.
That is correct.
So larger than the country of Germany, larger than most European countries. And so, stablecoin is just one-to-one backed by the dollar and trades like the dollar, always one-to-one. So in that use case, volatility has been taken to zero.
Right.
And so what you have is people are using these stablecoins in parts of the world where the payments infrastructure doesn't work. Maybe they don't have great apps that, they don't have Venmo, or maybe they're moving across borders and the apps on different sides of the border don't, work for this kind of thing. Maybe it's people in countries like, for a long time, Argentina, mm-hmm. and actually Venezuela were big hotspots for crypto, where, it was broken, right? Their local currency was broken. And so people were wanting to flee into the dollar, and you could try to get physical dollars, but that was hard. So people were buying digital dollars, crypto dollars, mm-hmm. Tether, and these other stable coins. And so you're seeing pockets of adoption, deep adoption in different parts of the world and different segments of the economy. And what I actually think you're going to see from an adoption, global adoption standpoint, is some of this stuff's going to kind of happen in the background, right? Where adoption is certainly growing. There's now equities trading on chain. Our stock trades on chain. Mm-hmm. But people aren't jumping up and down about it because it's kind of this back-end infrastructure powering things. And so people will just be like, well, my app allows me to send dollars around anywhere in the world really cheaply and instantly. That's pretty cool. I don't really know how it works, but it solves my need. And they go back about their day, going to the grocery store or something. But in the back end, the app, Cash App or Venmo or whoever, they're using stablecoins, right, or they're using blockchain. And so I think you're going to see it be this back-end infrastructure in the same way that people don't run around saying, oh, I sent an ACH today and it was so great and fast. And, I used a wire and that wasn't great, right?
Right.
People don't talk about using the SWIFT system. It just kind of, money moves around and it works. And so I think that's what you're going to see more of. And so adoption is going to look a little different. It's not going to be like, the Bitcoin guy or the crypto guy going on TV and planting the flag saying adoption has now arrived,
right,
January 1st, 2027. So that's kind of how I think it's going to unfold.
Well, no, so two kind of interesting points about that is that one, Daniel Kang at the conference, he made a really good comparison. He goes, you watch Netflix, right? Do you have any idea how Netflix actually works in the background? And the answer is no. I just know I turn it on and I watch Netflix and it's all great. But you know how it all works, how it gets from Netflix to my television. I have no idea what happens in the background, and that's what happens with most people on how transactions work. But your point about the use of stable coins, I was just reading an article recently, like in some South African or some African countries, and you were talking about access to technology and those type of things. Remittances are a very big part of a lot of countries' revenue. In other words, so a lot of people in America, they will send money to those countries. So they remit their income back to those countries. But in some of these cases, getting money to people in those countries through normal means like Western Union, et cetera, I may want to send $100, but it'll cost me $125 to send $100. So I'm spending $225 to send somebody $100. Stablecoin takes care of all that and makes that a very cheap fractional transaction. And as as Daniel Kang was pointing out this past weekend, the cheapness of Solana as a good example. I did not realize how cheap it was to execute a transaction in Solana, but it's a fraction of a penny to send. If I wanted to send $100, it would cost me basically such a small fraction of a penny. The person on the receiving end winds up with $100.
That's right. Yep. And we pay, like here at DFDV, we pay a lot of our bills in stable coins. We prefer it whenever we raise capital for projects. We prefer to receive stable coins to raise money from investors in different parts of the world. And it's so much better getting paid over crypto because it's so fast. It's instant. No wire delays, especially international wires. Even going from like Canada to a US bank can take like a week. And certainly it's not going to work on the weekend. And so I think what you're going to ultimately see is banks integrate this stuff. And it's like, hey, look, now you can send money instantly anywhere in the world to any bank and it's free.
Right.
And you're like, wow, this is amazing. And it's just, blockchain, probably Solana on the back end.
Right. Yeah, because even like today, I do a lot of business around the country. And so if I send a wire today, if I don't get it out by 2:00 in the afternoon, it doesn't go until tomorrow. And even if I send it out before 2:00 today, it may not get credited to their account till a day or two later when they verify the funds. And stablecoin resolves all that. I mean, it's an immediate verification. It shows up on the other end instantaneously. They have access to the funds. And that's a great thing. If you're doing business, that's a great thing. But again, this goes back to our previous conversation about volatility, which is the beauty about stable coins is that they are stable, right? I don't have to worry about that transaction showing up with a 20% discount within a few minutes, right? So that's a hugely important thing. And I find this just a tad humorous from this standpoint, because for years, I had people in the Bitcoin community saying, oh, the whole reason for Bitcoin is to get out of fiat currency. And I don't want to be in fiat currencies, so I want to be in Bitcoin. I'm like, but you're trading in dollars. And the beauty about stablecoin is that it's backed by treasuries, which is the US dollar. And to your point earlier, it's pegged to the US dollar. So you get that benefit. But you're not getting, and I understand there's a lot of narratives out there. And this is the one thing I try to really educate people on, is like, be careful of the narratives. When people are promoting something, telling you to get into something for some reason or the other, be careful of the narrative versus the facts. But at the end of the day, this is just a different form of the dollar. It's a digital form of the dollar, which I think is fantastic, right? I mean, it's the strongest currency in the world. It's the deepest currency in the world. We have the rule of law. We have the military to back it up. I mean, there's lots of reasons for it. But I think this provides a whole lot of stability to the financial system, but also provides a lot of stability to investors that do want to just be out of raw dollars, and for whatever reason, it does give them another way to play that.
Yeah, absolutely. And I think, the cool thing about stable coins, and this is, the Congress passed the Genius Act, and they called it the Genius Act for a reason. And I think underlying that, and some people have been very open about this, Treasury Secretary Bessent has talked about this a lot, but the power of the stable coin is it's essentially exporting dollars globally. So in all these corners of the world, whether it's Africa, whether it's Latin America, all over Asia, where maybe they prefer to use dollars instead of their local currency, but it's very hard to get access to dollars. They can't open US bank accounts, so on. All of a sudden, they have digital dollars and anyone can use it. All 7 billion people on the planet can use it. And you might think, well, but maybe there's a Euro stablecoin and a Chinese yuan stablecoin. Actually, not really. I mean, they exist, but it's like 500 billion US dollars in stablecoins and then like 5 million in euros. I mean, it's just like nothing. Like everyone wants to use dollars.
Yep.
And so the extent that the world goes more digital, what you actually have is dollars becoming the dominant, even more so than today in global finance, becoming the dominant trading asset for everything, which if you think of it from a nationalistic perspective, you know, you're a big patriotic USA, you want the dollar to be preeminent. This is actually incredible for dollar, you know, exporting dollars globally. And so, you know, I think, you know, the Republicans, or at least some folks within the Republican Party, certainly have understood that. You have some folks on the other side as well.
Sure.
But I think it's becoming a realization, you know, bipartisan, and Genius Act was bipartisan, becoming a realization that like, oh, we need to pay attention to this because this is going to be really important for U.S. Hegemony going forward.
Right. Real quick, because I want to wrap this up. Could you just talk about the 2 acts that have been passed, just from a really high level? Just, you know, because we talked about both these acts. We talked about the Genius Act. We talked about the now the name escapes me.
Clarity.
The Clarity Act. Thank you. The Clarity Act that's in process of being passed. Can you just talk from a real high level, kind of what was important about these, from each one of these bills, what was most important to your business, but also just to the crypto community in general?
Yeah, so the Genius Act was all about stablecoins. It was creating a regulatory framework to have basically onshore kind of stamp of approval stablecoins and then your offshore stablecoins. And so this was the first act, the easiest to get done, and, you know, highlights all the strengths we've just been talking about with stablecoins. So really make it legal for banks to really get involved. The Clarity Act is designed to do just that, bring clarity. And the problem that we've had in the crypto ecosystem for the last, you know, let's call it 6-8 years, has been the lack of clarity. And so what you've had is the SEC and the CFTC trying to kind of regulate via enforcement, and Gary Gensler was very hostile to the industry and being, you know, kind of two-faced or kind of, you know, talking out of both sides of his mouth kind of thing. And so the purpose of the Clarity Act is to really provide some guidelines for the rest of the industry beyond stablecoins. So it's definitely a more difficult bill to get done. That's why it hasn't been passed yet. But it covers things like DeFi, on-chain activity, exchanges. It's actually going to cover some areas of stablecoins again, but it's going to cover a lot of these different areas. And so if we can get the Clarity Act over the line, it'll bring a lot of regulatory clarity to the space. And the real purpose, the goal is, and the Trump administration has been very explicit about this, is to make the U.S. the home for crypto development. Because under the last administration, it was kind of pushed offshore, and, you know, developers were leaving because of the hostile approach. And so trying to, just like Trump's trying to reshore manufacturing, also trying to reshore crypto development.
Right. Well, you have my vote. Gary Gensler was the worst SEC chairman we've ever had. So, you know, I'm right there with you. Do you think either one of these acts, was there anything that they didn't go far enough on, or do you think there's something that they should have included that would have helped, or maybe something that might be considered in the future that would be very important to even just your business in general that make things better?
Yeah, you know, the Clarity Act has not been passed yet, so I can't really comment on that. I'm sure I'll read it when the final bill comes out, and there'll be some things I wished were in there and changed. I do think they got the Genius Act pretty good, pretty well done. You know, maybe not perfect. The bank lobby really came in to limit the ability of stablecoin issuers to pay yield, to kind of protect their monopoly on checking accounts and savings accounts not paying anything. So
that's a daily fight.
Yeah, right. So I think, you know, Genius Act could have been a little better if it allowed these stable coins to pay yield, because otherwise all these issuers are just keeping all the yield.
right?
Which is what the banks are doing anyways. There will probably be more things in the Clarity Act that I wish were changed, just because it's a much more expansive bill and there's a lot more parties involved, a lot more give and take, and push and pull. But we have to see what the final version is when it comes out, because there's a lot of back and forth and amendments, and it's still undergoing the process.
Well, let me rephrase the question then. What's the one thing you hope comes out of the Clarity Bill?
Yeah, so the biggest thing is making sure that software developers are protected under the First Amendment. So you've had a few cases where developers have written some code, deployed it on chain. They just wrote some lines of code, typed in your computer, deployed it on chain, and are being prosecuted for the code that they put on chain. Now, these are related to some basically mixers or the ability to kind of provide some anonymity. But there's been a real push by certain factions in the U.S. government to basically require software developers to perform KYC on anyone that interacts with their code, or even ban the writing of code, which is a complete affront to everything that the U.S. stands for.
Right.
It's an affront to the First Amendment. And so there's a balance there, but striking that balance in terms of when a developer has kind of crossed over into broker-dealer land or custodian land, sure, they should probably be regulated or, have some disclosure requirements. But if a developer is strictly writing code that people can do with it what they want, we need strong protections there,
right?
Because the alternative is the next administration or any administration comes in and decides, we're just going to pursue a bunch of legal action. And so then all those developers are going to leave the US, and the US will not be the home for crypto development. So that's a really key piece that needs to be included. And so far from what I've seen, pretty good progress on that. So I think it will be included.
Awesome. Parker White, CFA with DeFi Development. DFDV is the symbol for their company. They are a digital asset treasury company that uses Solana as the backbone for their digital asset treasury. Very fascinating case. Just had Daniel Kang present at the Economic Summit. He was fantastic, talking about how their business operates. And of course, Parker White, CFA. Great conversation today. Thank you so much. It was very educational. I think our listeners will really enjoy this and get a lot out of it. And I certainly appreciate your time today. So I thank you very much for that.
Thanks for having me on, Lance.
Absolutely. That concludes today's interview edition of The Real Investment Show with Parker White. And again, check out DeFi Development. DFDV is the symbol. You can go to their website as well, defidevelopment.com. Learn all about them and what they do. That's on the web. Of course, get by our website, realinvestmentadvice.com. Be sure and like and subscribe to the channel here, because it helps us keep bringing great guys like Parker White to the show. We want to keep doing that for you as well. Have a great day. We'll see you back here on the next edition of The Real Investment Show.